What's up, guys? Everybody's talking about ETFs, but what's the real deal? Let's find out. ETFs, or exchange-traded funds, are like a mix between stocks and mutual funds. They have become all the rage for good reason. Unlike mutual funds, ETFs trade like stocks, giving you more flexibility. But here's the kicker: they often have lower fees. It's win-win, right? Now, let's get to the juicy part. The top 5 ETFs for long-term gains. Before that, we'll address a question that people still wonder. What's the difference between ETFs and mutual funds? We'll break it all down, starting with the key similarities and differences, followed by 5 top ETFs to consider for long-term investing. And don't miss the bonus information at the end. It's packed with crucial insights to help you make smarter investment decisions. If you're already familiar with the similarities and differences between ETFs and mutual funds, feel free to skip ahead to the section where we explore the top ETFs to invest in. For everyone else, let's dive right in and explore. First things first, both mutual funds and ETFs, or exchange-traded funds, are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets like stocks, bonds, or other securities. They're great tools for diversification and can help you achieve your financial goals. But they work a little differently. Let's start with the similarities. Both mutual funds and ETFs offer diversification. You're not putting all your eggs in one basket. Professional management. Fund managers handle the investments for you. Variety. There are options for every investment style: stocks, bonds, sectors, even thematic funds. Accessibility. You can start with a relatively small amount of money compared to buying individual stocks or bonds. Now, let's talk differences. This is where mutual funds and ETFs start to stand apart. Trading. Mutual funds are priced just once a day after the market closes. So, if you place an order during the day, you'll get the closing price. ETFs, on the other hand, trade like stocks on an exchange. Their prices fluctuate throughout the day based on supply and demand. Then there's fees. ETFs tend to have lower expense ratios compared to mutual funds. That's because most ETFs are passively managed, meaning they track an index, for example, the Nifty 50. Mutual funds can be actively managed, which often means higher fees to pay the fund manager. Minimum investment requirement. Mutual funds often have a minimum investment requirement, which could be a few hundred or even thousands of rupees. ETFs? You can buy just one share, making them more accessible for small investors. Now that you know the basics, let's talk about some ETFs you can consider for long-term investing. While ETFs are gaining popularity and offer many options, it's important to consider liquidity. Liquidity refers to how easily you can buy or sell an ETF without significantly affecting its price. Some ETFs may have low trading volumes, meaning there aren't enough buyers and sellers for that product. This can become a problem when you want to sell your ETF. If there aren't enough buyers, you might be forced to sell at a lower price than expected. To avoid this, we will focus on ETFs with good liquidity and a strong track record. Here are 5 solid options. First up is Nippon India ETF Nifty 50Bs, also referred to as Nifty Bs. This ETF tracks the Nifty 50 index, giving you exposure to India's top 50 companies. This is a low-risk category and a pretty safe bet. Now, let's talk numbers. The assets under management, or AUM, for this ETF is a whopping 36,638 crore rupees. What does that mean? Essentially, AUM is the total market value of all the securities that an ETF manages on behalf of its investors. A higher AUM often signifies greater trust and confidence from investors, suggesting the ETF's popularity. There's more good news. High trading volume observed on the NSE suggests this ETF offers excellent liquidity. In simple terms, this means you can easily buy or sell them without any hassle. Next, let's discuss the expense ratio. For Nifty Bs, it's just 0.04%. The expense ratio of an ETF is the percentage of the fund's assets that are used to cover its operating costs. A lower expense ratio means more money for investors. A higher expense ratio means a lower net return on your investment. Now, on to tracking error. For this ETF, the tracking error is just 0.03%. Tracking error is the difference between the returns of an ETF and its benchmark index. It's a measure of how closely the ETF replicates the index. Tracking error cannot be zero, but the lower the tracking error, better is the alignment to its benchmark index. Finally, let's look at the returns this ETF has given in the last 10 years and 20 years. Over the last 10 years, the Nifty ETF has delivered an annualized return of 11.3%. But if you look at the last 20 years, that number jumps to an impressive 14%. So if you are considering adding a solid, low-risk ETF to your portfolio, Nifty could be a smart choice. With its high AUM, low expense ratio, and solid returns, it's definitely worth a closer look. Finding this helpful? Share with friends who would like to know about ETFs. And don't forget to like and subscribe for more informative videos on personal finance. The next ETF is Nippon India ETF Nifty Next 50 Junior Bs, more commonly known as Junior Bs. This ETF focuses on the next 50 companies below the Nifty 50, offering growth potential. The risk level is moderate. AUM for this ETF is 5,482 crore rupees. The expense ratio is 0.17% and the tracking error is 0.09%. Over the past 10 years, this investment has demonstrated an annualized return of 13.3%. It's important to note that financial markets experience fluctuations. At the time of creating this video, the Indian market is undergoing a period of correction, which is impacting the performance of most investments. However, when considering the investment's long-term track record, like 20 years, its compounded annual growth rate reaches 15%. The third ETF we will look at is the HDFC Nifty Smallcap 250 ETF. It invests in a basket of 250 small-cap companies listed on the NSE, and it tracks the Nifty Smallcap 250 index. Investing in small-cap companies carries higher risk compared to investing in larger, more established companies. And thus this ETF falls in the high-risk category. The AUM for this stock is 759 crore rupees. The expense ratio is 0.2% and the tracking error is 0.15%. The liquidity is high. This ETF was listed in February 2023, making it relatively new to the market. Since its inception, it has delivered impressive absolute returns of 82%. At its peak, the ETF experienced a remarkable 109% return. This ETF is essentially for investors with a much higher risk tolerance and a very long-term investment horizon. The next ETF is Gold Bs, officially known as Nippon India ETF Gold Bs. It tracks the price of physical gold in India. This ETF is for investors seeking to diversify their portfolio with a hedge against inflation and market downturns. The AUM is 15,189 crore rupees. The expense ratio is 0.81%, which is slightly higher than some of its competitors. However, this ETF offers a significant advantage in terms of high liquidity. As there is no underlying index specifically for gold, the traditional measure of tracking error is not applicable in this case. The annualized returns for the past 10 years is 10%, and for the past 20 years is 10.3%. The Indian market is currently experiencing a period of correction, and the Indian rupee has weakened against the US dollar. During such times, gold often acts as a safe haven asset. As observed, the price of gold is rising, demonstrating its potential as an effective hedge against market volatility and currency fluctuations. ETF number 5 is Motilal Oswal Nasdaq 100 ETF. MON 100 tracks the Nasdaq 100 index, providing exposure to leading U.S. technology companies. The AUM is 8,868 crore rupees. Expense ratio is 0.58%, and the liquidity is high. The 10 years annualized returns is 23.6% and 20 years annualized returns is 16.4%. As it tracks a U.S. index, the performance can be impacted by fluctuations in the exchange rate between the Indian rupee and the U.S. dollar. This ETF is ideal for investors who seek exposure to foreign markets without the complexities of investing directly in international stocks. Here's the bonus section. Let's dive deeper into some exciting investment options beyond broad market ETFs. First up, we have sector ETFs. These funds specialize in specific sectors of the economy. Imagine you believe the future of healthcare is bright. A healthcare sector ETF would allow you to invest in a basket of companies operating within that industry. Then there are thematic ETFs. These innovative funds focus on cutting-edge themes like artificial intelligence, renewable energy, or e-commerce. They tap into the growth potential of emerging trends. Investing in sector and thematic ETFs requires a specific approach. High risk tolerance. These strategies can be more volatile than broad market investments. Long-term horizon. These are typically long-term plays, ideally 5 to 7 years or more. Thorough research. It's crucial to carefully research and select well-established and reputable sector or thematic ETFs. If you meet these criteria and are comfortable with the associated risks, exploring sector and thematic ETFs could offer exciting opportunities for portfolio growth. That's a wrap, and now you have some solid ETF options to consider for your portfolio. Which ones do you prefer? Let me know in the comments below. Don't forget to like, subscribe, and hit that notification bell for more simple steps to financial freedom. Stay tuned, and see you next time.